Hello YouTube and welcome to another video. I'm Duarte from Still Not A Millionaire, and before going into our video I just want to remind you that we are still going with our giveaway where you can win a free copy of this book, Rich Dad Poor Dad. This is an international giveaway, so feel free to join us and make sure to subscribe in order to be aware of future competitions. If you are an American citizen or simply if you enjoy football, you might be quite excited with today's Super Bowl game. And in today's video, we'll try to see how this match can decide how the stock market will or will not behave in the coming period. Before starting, personally, I live in Portugal, so I don't know much things about what's happening in the American Football League. Okay, but today there will be some sort of big game, and the Super Bowl is you probably already seen the news, is one major event to make an advertisement between this game. It can cost like 4 or 5 millions for only 30 seconds, so you can already see quite the dimension of this type of events. And in fact, in the previous, I think it was already in 1978 or so on, that one author, Leonard Coppett, that was a sports writer for New York Times, came up with a sort of indicator in order to try to predict, depending on which team won the Super Bowl, how the market would behave. In fact, this indicator, the Super Bowl indicator, simply tells you that if the team that wins belongs to the National Football League, American football, well, AFC in the diminished version, then the stock market should decline in coming period. On the other hand, if the winning team belongs to National Football Conference, okay, and as well as teams from the original National Football League, NFL, the stock market should rise in the future. This is only a conclusion that was taken based on a correlation inference that was made by the author, but as you probably are guessing, there is no causality or there's no rationale behind such indicator. And in fact, well, the truth is that this indicator in the recent years hasn't been quite correct. Okay, for example, since 2016, it has been wrong in every year. Okay, where the winning team was AFL. Okay, and the stock market, where stock market increased in the next period. Okay, measured by the S&P 500 return in this case. And when the NFC team won, the stock market declined. Okay, so it has been wrong in several of the previous years. One of the interesting things this year is that the Tampa Bay Bucks, okay, this team doesn't belong neither to the AFL nor the AFL, and the conclusions here can be quite ambiguous, and the initial author, Coppett, hasn't declared how the indicator should be, how it should be interpreted in these situations. For example, I think that it first in one situation said that well, it should also lead to a bullish indicator, but afterwards in 2003 he said that the indicator would say nothing about this type of in these circumstances. Okay, well, the interesting is that it all started with a joke. Okay, as we have said in the previous article, Coppett was only a sports writer, okay, and he introduced this as a sort of joke, not to be taken seriously. But in fact is that it had a major impact in the coming years, and a lot of investors have really thought that there was some causality. And remember the difference between correlation and causality. Okay, many investors saw this indicator and were paying attention to which team won, and they made bets depending on the league of the winning team. Okay, and at the first glance, at least, I don't think that there is a significant correlation between the two things. You can find a lot of other indicators like this that at the first glance might not have a significant causality, and in fact they don't have any causality between the facts studied and the stock market. Okay, but nevertheless it's interesting to see how this have gained some relevance within the investors community. And we are talking about things like the lipstick indicator. Okay, the idea is always to assess if the market is bearish or bullish in the coming years. Okay, for example, lipstick indicator, it tells that when individuals feel uncertain about the economy, they turn to less expensive vanities such as lipstick. Okay, so a higher consumption of lipstick would suggest that the market is uncertain. Okay, the Wall Street job indicator, that says that when demand for jobs in Wall Street increases, it means that it is becoming too attractive. A lot of people are attracted to stock market, as we probably are observing in the current days. Okay, and that might be a sign of a bubble, and so on. Okay, so what I want you to leave with this video is simply this, that well, investors and speculators in this situation can be quite creative, but you need to think for your own, and why not creating your own indicator. Okay, and well, see if it has some correlation with the stock market or not. But don't forget to remember that there is a difference between correlation and causality, and most of these type of indicators are created only because there it is found some sort of pattern. We are talking about correlation, but the truth is that in reality it makes no sense to connect one thing to another. Don't forget to like this video, subscribe, and if you want to, feel free to join the giveaway of this book, Rich Dad Poor Dad, that is currently undergoing, and I will see you in the next video.